Welcome to the Treasury Update Podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. Welcome to the Treasury Update Podcast. I'm Meredith Zonzias, Communications Manager at Strategic Treasurer, and today's host. Our featured speaker is Craig Jeffery, our Managing Partner and Founder. Today, we're excited to cover some of the most frequently asked questions in Treasury. So far, we have released podcasts on the first and second round of FAQs submitted by various Treasury and finance professionals. Today, we continue with FAQs in Treasury Round 3, covering Treasury topics around hedging, finance, accounting, and more. Welcome to the show, Craig.
Hello, Meredith.
To kick off Round 3, does accounting matter in Treasury? Where does accounting matter in Treasury? And should Treasury book the accounting entries?
Yeah, I'll try to answer them fairly concisely, which is against my nature. Almost everything Treasury does finds a home in a banking system or in accounting entries as a way of recording it. I mean, accounting is the language of financial recording. So obviously Treasury's moving funds, receiving items, making investments, accruing interest, et cetera, so that it matters in Treasury for all the transactions, of course. But I think to your other question, should Treasury book the accounting entries, or what the question is that people have asked this several different ways is, does Treasury have to book it, or does accounting or some other area book accounting entries? Do you have the subledger book entries and not book anything in Treasury? So I'll touch on a couple areas. Is like, initially, I don't really care where you book accounting entries. And I say that a little bit flippantly. It's running Treasury groups. My area had to book accounting entries. I don't care if Treasury books them or not. I think there's a couple considerations that you need to think about it. One is there is a sense of segregation of duties. Who's performing certain transactions? Someone separate has to book that. Does that need to be outside of Treasury or inside? Some of that is driven by size of the organization and activities and functions. So that box has to be ticked. The second is that it should be booked in an automated fashion as much as possible. And so if you have a banking platform, you have a treasury management system that can run logic and book those entries and then feed the general ledger, that makes sense. If it can act as the true cash book, keeping track of a full ledger, that can be great in the Treasury system that you're using. Does Treasury have to be the one who actually records entries or codes the system to generate those entries? No, it doesn't have to be. Maybe they do it because they're more familiar with the system and it's reviewed by an accounting or a GL group. That's perfectly fine. But the system should book those. I think the other part of that, how should they be booked? And we think about there was a long time when accounting was called treasury in ancient Egypt, et cetera, and there was, accounting was done by lists. And then there was the invention of double entry accounting. I'm not going to bore people with how that was set up, but double entry accounting allowed for a great process of balancing activities. Every debit has a credit. You can make sure certain things aren't missing and provided nice controls, and that worked particularly in a unautomated world. It just made sure things matched and worked quite well. Obviously, double entry accounting still works, but sometimes there are multiple sources of that. I don't necessarily want to create a term of triangulated accounting, but I said earlier, is like AR is booking things. They're getting a feed from the bank. They're booking things in their accounts receivable, subledger, and they might be hitting cash. Well, Treasury is also receiving that information into their cash subledger, and they can either book an entry or not book an entry, suppress it and feed it or not feed it to the general ledger. And I think when you have fully automated systems, this idea of, and I'm going to, I guess, keep using that term, triangulated accounting, is Treasury can, and in most cases should, book everything that flows to the banking system. I mean, obviously investments, if they're tracking investments, they're not an insurance company, they're an investment accounting group. They're tracking debt, they're booking things there. They're going to book those. But all of the operating activity, which for some organizations may be admin system related, it may be accounts receivable, maybe accounts payable related. They see stuff coming through the bank system, and instead of letting that information hit the floor or suppressing it, they can book it to cash in a clearing account that's designated to a particular area like AR. AR can receive their file to post and relieve AR, and they could book it to a cash clearing as an example, cash clearing for their particular area. And that would be that matching process of cash clearing allows Treasury to book all cash through the system, and it's done on an automated basis. It's done on a comprehensive basis. And what's done in AR, for example, is they're booking everything they get, maybe from a lockbox feed or a digital feed. They're booking and clearing the receivables. And the other point on that is that the cash clearing, for GAAP purposes, for accounting purposes, would also be treated as cash, but they would wipe each other out. They'd be designated to a particular area. That way you have complete booking of everything that hits the bank on an automated basis, and you have everything that comes from a feed, perhaps from a bank or a third-party system that's receiving it, booked from the subledger system. That way, that cash clearing account handles it. You'll see any discrepancy noted there. That is certainly what most leading companies are doing, and you can't do that if things are manual. That's just way too many entries. But in today's world where we can automate both sides, it can identify and create a process that is much more easier to see when there's a problem or discrepancy, rather than only waiting for cash or bank reconciliation to discover that 10, 20 days after the month-end close, or perhaps several months later. So maybe I'm introducing the firm triangulated accounting, but other people say that's just clearing accounts.
Do you want your hedges to make money?
Generally, no. What's the purpose of hedging and risk management in Treasury for most organizations like corporations? The purpose is to reduce your volatility, reduce your exposures, to bring them in line with not only your risk capacity, which may be pretty large, but your risk appetite, what you're willing to bear. And so you're trying to reduce the volatility, and reducing volatility is a different model than if you're in a hedge fund. A hedge fund will take positions on things. A hedge fund will take positions on what's going to occur with FX movements or the price of commodity or oil. That's their businesses, is betting on those things, or to having a view to the market. Whereas most Treasury groups, most Treasury organizations, their goal is to reduce volatility and bring it in line. So that's a general background for it. But your question is, do you want your hedges to make money? Someone says, we would have done better if we didn't hedge. The hedge was out of the money. It lost money. Well, what were you trying to do? You were trying to bring your exposure in line. You didn't want to suffer a loss of a certain size. So therefore, it made sense to hedge, use a financial instrument to reduce that volatility. And that, I think, is important to know. You're trying to reduce your exposure and bring it in line with your risk appetite and in line with the policies that you have. Now, normally, you're hedging a portion of what your exposure is. So it's only a certain portion of it. So you have an underlying exposure, let's say a variable interest rates on some debt you have. Your exposure is interest rates could go up, whatever your base is. Maybe it's based off of LIBOR or SONIA or SOFR, whatever. It's based off of a new standard, let's say, and those rates go up. Well, now you're exposed to paying more for your debt. Maybe you don't want the full exposure if interest rates go up 2%. Maybe you only want to bear half of that, or 1%, let's say, for example. So you put an interest rate swap in for 50% or maybe 70%, whatever the number is. But typically, you're not hedging 100%, right? You're not hedging 100%. You're hedging some portion. So if your hedges make money, your underlying exposure loses money. And your underlying exposure is in most cases larger than what your hedge coverage is. If you made $1,000 or $1 million on your hedge, you might have lost $2 million on your underlying exposure. And I'd rather not make money on the hedge. Most people wouldn't want to make money on the hedge for that type of reason, if that's the focus of your hedging. Now, that's not the only answer. Is maybe you're hedging, you're reducing volatility to bring in line with that. And also could be that you're hedging to present yourself in a better financial situation than your competitors in trying events. So maybe your competitors aren't hedging and you're hedging 75%. And so making money with your hedges means you lost on the underlying, but it's muted because every $4 of loss on your underlying exposure, interest rates or commodity price variations, means you get $3 from your hedge. So $100 means you only had a $25 loss. Well, you don't necessarily want that loss, but maybe positionally you want to do better than your competitors because you see it as volatile. That's a position of strength or whatever you're doing. If that's what you're doing, then perhaps you want your hedges to make money. So I only see it if it's a competitive position and it advantages you because you reduced your exposure there or because you're a hedge fund. But usually you don't want your hedges to make money. And it's an insurance factor. And so you don't say, I want to make claims on my insurance policy. No, you don't want that accident in your car to claim it. You still have underlying loss. You pay the deductible. It's the same type of concept with hedges.
Would you say there was any differences between privately held companies and publicly traded companies in that regard?
Yeah, there certainly can. That's a really good question. So that goes down to why do you hedge and do you want to qualify for hedge accounting purposes? So a public firm, well, any firm has an economic aspect of hedging. I want to reduce the actual financial loss over time. And that's when you put the hedge on for economic purposes. Now, there's also an accounting feedback loop, I'll call it, with hedge accounting, based on effectiveness and ineffectiveness of the hedge. How well did the hedge do for what it's reported? I'm not going to go into all of what can cause that. But the effective portion of the hedge, if you've qualified for hedge accounting, in summary terms, can roll through an element of the balance sheet, usually referred to as other comprehensive income. It's in the balance sheet rolling through that category, and then it gets released to the income statement according to a schedule and according to terms based on which accounting regime is being used to do that. What that means is if part of your hedge is ineffective or all of your hedge is ineffective, you don't care to qualify for hedge accounting, all of that element impacts your income statement right away. So while the economics may be ideal for what you're doing, there's a feedback loop into the accounting record, so everything shows up in your income statement. It's not slowed down through like a water retention pond, right? When there's a flood, stuff flows there and it releases into the lake, eliminating the flood. Well, OCI is that retention pond that can release it more slowly. Now, when it releases it quickly, it has an impact of volatility on the income statement, not economically, but the income statement. And that can change how people and investors value companies because they want to see nice, steady earnings, this gradual trend up. They want it smooth. And so there is a feedback loop to hedge accounting that can exacerbate the situation or moderate what they're trying to do. Not economically, but from a reporting standpoint, which has another economic benefit of organizations investing in those companies. I don't know if that made sense or if that was just a lot.
Thanks for sharing. Do you want more working capital or less?
Yeah, that question is made up of a lot of different feedback elements. I'll say, it depends what your definition of working capital is. The accounting and banking definition is current assets minus current liabilities. So in that definition, you want more current assets than current liabilities. So you would want more cash, more receivable, because that shows your ability to meet funds and requirements, financial requirements as they come due. So that's a measurement that, yes, you would want more working capital, or generally you'd want more working capital rather than less. So what Treasury looks at are those that are managing working capital. The cash conversion cycle they look at a formula of accounts receivable plus inventory minus accounts payable. And this, certainly, it doesn't have cash in it. So converting an accounts receivable to cash is viewed more positively. Every treasurer knows that's better to have cash versus a receivable. Actually, every person knows that's better when you're looking at it from that perspective. So this is how much cash is tied up in your cash conversion cycle. And how much cash you have tied up in that is a reflection of how efficient are your financial processes. You can have accounts receivable grow very large, and that will increase net adjusted working capital or working capital from the accounting definition. That could mean you're collecting slowly. You have terrible terms. It could mean a number of things. So you don't necessarily want more or less there. You want to make sure that it's balanced and optimized. So you want to set fair terms. You want to make sure you're collecting properly. You want to make sure you're converting cash to goods, from inventory to goods, selling it, converting it to receivables, converting it back to cash, and at the same time paying with whatever terms make sense. So you may want less working capital with that definition. Collect faster instead of an average of 45 days when your terms are 30. You want to make your collections more efficient. But you do want to optimize it. You don't want to just reduce inventory down to nothing in most businesses. You want to make sure that there's a process that is efficient and a process that helps you sell. You have no washers and dryers in your warehouse, and it'll take 5 days to deliver it. Someone whose washer breaks, like a situation I had some time ago, it broke. And one place was managing inventory very tightly, and I think we could get the washer on Thursday. I think it was a number of days. Whereas another place, buying it on the weekend, I could have delivered Monday morning. I would have been in great trouble if it took me 4 days to get a washer, and I was in the clear if laundry would only pile up for a few days by getting a washer on Monday. So that can impact sales. I have more color choices. I have physical goods that can be picked up or can be delivered within a certain period of time. That provides ability to increase sales, manage risk, et cetera. So it's a method of optimizing each of these, optimizing your terms so that working capital makes sense. So traditional definition, current assets minus current liabilities. The accounting definition, usually you want more. The others, it depends, but you certainly want to optimize working capital using the Treasury definition of how we manage the cash conversion cycle.
Great. That's helpful information on working capital. The final question, what are the different perspectives on finance?
Yeah, some of the different finance perspectives, where you look, what you're doing, what the purpose is, tells a story that's important. And I'll be quick, but just a couple things. And I don't want to overgeneralize it, but what's the primary purpose of, let's look at the controllers group and the accounting group. So the controllers group is mainly concerned about financial reporting and that the controls they have will detect issues. And a lot of those are driven through financial statements. So the primary focus is financial recording, a historical look, what's going on, making sure everything's recorded properly in time, and that the system would detect any type of control issue, and you'd be able to find it, have a good audit trail, et cetera. And there's clearly some elements of looking forward, from that perspective, planning and making sure things exist. But the primary orientation is financial reporting and historical. In Treasury, the primary orientation is forward, looks to the future. What will our balance sheet need to look like? How much cash do we need to have? And so they're looking there. And then this might be a short-term forecast out 6 months. It might be capital planning out 2 or 3 years. And so their orientation is forward. It's focused on liquidity and what's coming around the corner. And yes, they have to look back to do forecasts. And so they look back just like the controllers groups look forward, but their primary orientation is forward. Together, they accomplish many of the key elements of finance. Now, the FP&A group is one other area I'll talk about, since you relayed the range of questions that talked about what did you refer to it, the perspectives on Treasury, or the direction of the look? I guess it was perspectives.
Perspectives.
Yeah. So FP&A primarily looks forward far, and looks forward in large time domains to see what the income will look like in that period of time. What will our profit margin be? And so they will look with that orientation. And while there's been a lot of progress with some of the tools that FP&A uses to say, yes, we have an income statement orientation, a profit orientation, and we can back into what that will do to the cash side, that's a more recent development, and it's maturing. It's probably not a teenager yet, but there's definitely some progress there that exists. But their orientation is income statement, long time frames, and large buckets. And Treasury, when Treasury looks forward a long time, they're looking for, do we have enough capital and cash, access to credit to meet those needs over time?
Thanks for this informative interview, Craig. For our listeners, thanks for tuning in to the Treasury Update Podcast. If you would like to listen to the first and second round of FAQs in Treasury, visit us at strategictreasurer.com/podcast. Thanks for your support.
You've reached the end of another episode of the Treasury Update Podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.